Good afternoon, everybody. Welcome to TraderMerlin Show. It is your Thursday edition. Getting to the tail end of the week, an exciting one. Boy, we've had some pretty big announcements which have fueled some great rallies. I actually sold most of my stuff into this rally. Everything that I had left, I just have that open QQQ position, which I have covered calls at 295. Sold out most of my, actually opened up a new position today, which is very one-day trade on BOIL, B-O-I-L, going for natural gas. We'll talk about natural gas here in just a little bit, but nothing like a 5% rate of return for one day with a fairly risky trade, but we'll talk about that as we go. So today's topic is going to be economic growth fuels more market gains. Yes, love the AI generator. Thought it did a great job at capturing a bull market rally driven by economic data and trading, etc. So that's what I got for today's show. I like that result myself. Before I dive into the economic data, though, I think we got to stop and real quickly look at the well, that was apparently what we're going to start with. I was going to go to earnings first. So let's just start with economic data. As we roll through here, there's really only one that jumps off the screen at us and says, okay, this was a major beat. And that was advanced GDP. And as I mentioned, there's three different readings of GDP. There's the one that comes out in January. That is going to be your advanced. And that is like the first look forward at what the quarter GDP number will be. In February, you will have what's called the preliminary, which is simply a revision of the advanced. And then in March, you get the final GDP number, which we already kind of know what it's going to be because we've already had the advanced and the preliminary. So I don't know why they do that. Seems weird to me to kind of have that little bit lagging, month by month when people really focus on the final GDP number when actually it's the advanced. So that's what came out today. We get our first real reading of what the GDP numbers might look like for March. And as you can see, very good. They were expecting it to go to 2.6, came out at 2.9. Now, as I did with the big thumbnail here to kind of tease the show, economic growth fuels more market gains. Well, let's take a peek at what happened in our markets. And I'm not going to run through them all yet. We'll do that a little bit later on. But here you can see that breakout. We talked about it, trading in that yellow zone, broke out of it today. So obviously very positive for anybody who's bullish. But when we look at the actual GDP number, here's your advanced GDP. I'm going to zoom in. I'll continue to zoom in here just so we can see it all a little bit more clearly. Right now, what you're looking at is the GDP numbers going back to 2000, right? So that's not that relevant at this point. Maybe to set a benchmark, like if I put a horizontal line here, what looks about average? Yeah, maybe 4%. Maybe that might be a little high. Yeah, there's 4% is where my cursor is at with that horizontal line. That seems to be average, if not maybe a little high. Maybe 3% looks to be about average. So anyway, let me zoom in to the current markets. So now we jump all the way in. I'm going to try to go right past the pandemic piece. So there we go. The reason I'm zooming in on this is because the Q2 number is actually Q1 of 2022 showed a contraction in GDP of negative 1.4%. And then we also had, following the next quarter, a contraction of 0.9%. Now that, of course, sent everybody into the discussion of, hey, we are in a recession. It's 2 consecutive quarters of negative GDP growth. And here we go, full-blown recession. Plus, we already have the inverted yield curve. So a lot of things pointing to just a debacle meltdown. Well, notice what's happened the previous 2 quarters, right? We had I forget which quarter this is for. I'll say the one I'm looking at right now, October, is Q3. That came out at 2.6%. And now we have our January one, which is going to be Q4. We're looking at 2.9%. So this is actually very positive. And what it's showing is a 1-year significant uptrend in GDP. We've gone from negative 1.4% to currently a 2.9%. I call that a 4.3% increase in GDP from those lows to highs. That obviously is a very positive sign. Now, that's not the only piece of economic data that came out today. That's just the most significant one that drove the markets. There was a lot of rosy stuff out there today. Look at the durable goods orders, right? These are goods and services that last, I think it's 12 or 18 months. We're talking refrigerators, we're talking refrigerators, microwaves, TVs, appliances, really, things that last a while. So durable goods was negative 1.7%. This is month over month. It jumped to 2.4, or expected to be 2.4. That would have been great by itself. We came out at 5.6, which means people are buying, right? There's stuff selling and orders are in for big equipment. That's great. Right underneath that, unemployment claims, it was expected to be 203,000 people, right? More people being laid off. It was actually a contraction. Went from 192 to 186. Great news there. And then you scroll down a little bit, and you look at the new home sales. New home sales was 602,000. They expected it to be 610, came in 616. So all in all, you've got some really positive data out there. It's positive on the GDP front. It's positive on the durable goods orders front. It's positive on the unemployment claims and positive on new home sales. So all in all, some really rosy numbers out there today. It doesn't mean we're out of the woods. Doesn't mean that this is just bull markets from here on out. But it does support the argument that this shorter term trend started back in December has some more legs, right? Could keep going. Now, do I think, again, I know a lot of you said maybe we're going to get all-time highs again. I don't think you'll see that this year, but things are starting to look a bit better. Again, my forecast is that we will see Q1 and Q2. Q1 for sure looking positive. Q2 maybe slowing down a little bit, and I think we'll start to see some more a change in some bad economic data near the tail end of the year. I just feel like this is kind of almost like a dead cat bounce for economic data, right? We've had it's just so bad, then have it bounce back up a little bit, and then maybe continue on down. So not exactly sure how that's all going to transpire, but there we go. So I see we got Led Zeppelin being talked about in here. No Tesla for me, Lisa. I think it's safe to say, barring an apocalyptic meltdown in Tesla tomorrow, I will not get executed on my options. So I actually had I think that was a great trade. It was a 1 week trade on Tesla. Yeah, we're at 160 right now. It was up another 10% today, and my strike price is down here at 125. So I need a 35-point drop before I get executed tomorrow. I could have closed out my options today. They were going for 1 penny, but why bother, right? And I don't see a reason why Tesla would drop that much tomorrow. So, yeah, I'm fine. I think I'm not going to have any Tesla in my account, which is a bummer because I told you, I actually said yesterday, I think we're going to get to the 160 mark, and I did not think we'd get to it in one day. We're already at 160 mark and looking pretty good. So I'm packing my bags for the Misty Mountains where the spirits go. Oh, we got a little Zeppelin reference over the hills. I am a Zeppelin fan, so don't get me started singing. Robert says, does that mean higher interest rates? Great question. So the discussion we've had on this channel, we've had obviously lots of discussions, but I think one of the main discussions on this channel has been the how one piece of data impacts the Fed's decision and how the Fed's decisions might impact a whole another set of data. So if we see GDP numbers increasing like this, we're not at a point where any economist would look at it and go, oh God, we're way too overheated. The economy's doing way too good. It's just a sign that things are getting better. Now GDP at 2.9%. Remember, looking at that chart, we could make the argument, and let me show it to you. We could make the argument that your historical level for GDP is roughly 3%. And the reason I'm just ballparking, but look at this green line where my cursor is. Right? I'll move that up, and I'm just going where it seems like it intersects most of this past economic data. And that's right about here. Some are above it, some are below it, but it seems to be about 3% seems to be normal. So we would technically be back to normal. Now, Robert and others, if we continue to see this rally up, right? Let's say this GDP number keeps going, and all of a sudden it gets up here to the 5, 6, 7%, then you might see a pivot. And then you might see them continue. I said it wrong. You might see them continue to increase rates because they don't want the economy to growing that quick. Having one piece grow so quickly while other pieces are contracting would kind of rock the boat too much. So if we saw GDP really start to accelerate and get to that 5, 6, 7%, I think that the Fed would actually make a statement that, look, we're going to continue to keep rates raised. We're concerned about the economy getting a little too hot. Right? That's normal in those types of situations. So that could mean higher interest rates if the economy continues to get too heated up. But remember, we still have the horrible I word, inflation. Right? Inflation's been looking much, much better. Therefore, that might give them cause to keep the course here. And you look at inflation numbers dropping, that would give them an argument to not raise. But then you have GDP, which says if it gets too hot, we need to raise. So again, so many moving plates in the air for the Fed at this point. Right now, I think the market's just rejoicing because it's been fairly depressed. We are seeing inflation subside. We had some horrible retail sales numbers, but GDP is painting a different picture. It's painting optimism, and markets like that. We saw some great moves out there. Let's bring up some charts here and just dive into that section of the discussion. I'll start with the worst for today, which was gold. I actually was looking at selling some puts on gold, but the premium was just not there. Just really no premium, which tells me that most people are expecting gold to continue to rally. Nobody's buying puts. Well, I couldn't get money from my puts today. Gold down 0.65%. You see, the trend is still intact. Again, I am still 2,000 is the target here. I think we'll get it in the next couple months. Right now, we are at 1930 on the gold futures, which dropped about $12.60 today. Now, it was pretty much positive for everything else. Russell broke through that key overhead level. We did not get I think we talked about getting a close above 1900, right? That was the number I mentioned yesterday. Let me put a line on the chart for you. And I said, look, it's pretty important that if we can get a line above a break and a close above 1900, which we have not done going all the way back to September of 2022, then that's pretty positive. And I think right now, the Russell kind of changed the tune a little bit, right? We did get a close above 1900. The candle looked great, a little bit of a retracement near the end, probably because Intel, which we'll talk about as well. But all in all, we're still in that giant range we've been established, in for 9-10 months now. So while it looks great, it just kind of becomes a discussion of where's your next target at, right? Your next target, in my opinion, is going to be 1965 on the Russell. And then, of course, going back to that peak over here from August of 2022, now you're looking at about, 2030. Still a ways to go to get to those levels. All in all, Russell looking great today at 0.58% gain. Gets even better with the Dow, which is 0.59% gain, although chart-wise, let me get rid of that yellow box. That's insignificant at this point. I think this line is dead as well. We'll get back to naked charts. I will wrap this one around, barring that real big wick that we had there and going to the main real bodies. This looks like what we're stuck in. Dow right in the middle of that range between 34,650 and 33,000. All right, so a pretty decent range, 1,500 points, and we're pretty much in the center of that right now. So for you spread traders, Tom, checking that one out. S&P 500, slightly better, almost double the rate, actually, of the S&P 500. It also broke out of that sideways range. So we were talking about waiting and confirming for breakouts. Well, you got one today. Now the question is, do we hit that 4,100 mark tomorrow? The way that we close I would have been led to believe, sure, we could get to 4,100 tomorrow, but Intel may have a hand in pushing things down a little bit tomorrow. Again, I'll talk about that in just a second. So 1.08% move up for the S&P, trading at 4,075 on the futures, a 43% gain. Nice move, nice breakout, especially after the about face we had yesterday with that giant bottoming tail on it. Now, crude oil. I had XLE done, dumped everything today. Great one. Crude oil didn't look great, but some of the oil companies, Valero in particular, reporting earnings, which I'll show you in a second as well, really helping this market rally. XLE looked great today, one of the bigger gainers in the ETF category. Crude oil, 1.07%, 81.01 is where it closed at, but again, stuck near these highs. It's just kind of sideways traversing, really for six sessions right now, kind of been stuck, not doing much. So next, Bitcoin. I love the chart of Bitcoin. We had a lengthy discussion in my CIL class this morning about kind of the shape and formation and what this pattern kind of is telling us, and it actually does echo in more bullish forecasts for crypto. As bizarre as it is for me, because I feel like there's so much negative media and press and outlook, just the technical side says we're probably going to continue to go up here in Bitcoin, right now up 1.72% on the day. But that's not your best performer. Best performer, NASDAQ 100, and a great day. Now notice where we are at. We came screaming back into this overhead supply level, which on the NASDAQ 100 futures is about 12,111, and that's where we stopped. Right now we're at 12,106, so just a couple dollars off that. It would not surprise me at all to see a nice correction tomorrow. I kind of feel like it's in order. I mean, look at the move we've had just over the past couple of weeks in the NASDAQ. This is not very typical. Going from the bottom, which was on January 6th, to where we are today, you're talking 12.67% move up in the NASDAQ 100. Now, that's off the dead low. For the year, the NASDAQ is up 8.56%, and for the year, the S&P is up 4.5%. As you guys know, there is an old mantra that says, as goes January, so goes the rest of the year, which means if we get another few days plus, the first part of next week, closing positive for the S&P 500, then there's a good chance that we would see the end of year numbers be positive as well. So that's another little something to think about as we look at historical data. Santa Claus rally worked. There's one that says that as the first 3 days of January goes, so goes January. And then there's as goes January, so goes the rest of the year, all backed with statistical evidence to support those arguments. So looking pretty damn good out there. That was your best performer on the day. And of course, the Tesla one was just phenomenal. Tesla, I'm disappointed because I was selling those puts because I wanted to buy Tesla at 125. I wanted to buy Tesla at 100. My puts will all expire worthless. Totally fine with that. You know, got a nice 1.5% rate of return for the week. I'll take it. But where we are right now with Tesla, you know, this isn't really a strong supply zone at all. I don't think there's anything really here that screams that it should stop Tesla from moving on to the upside. And I think part of this also is short squeeze. As we know, there's a lot of people out there who are short. I think that Bill Gates might be giving back some of his gains as well, as we've bounced from roughly 100 to about 160. I mean, that's a 50% increase from these lows that we saw just on the January 6th to where we are right now. It's a 57% increase. I know. I do. I need to do more short-term stuff. And, you know, I'll talk about Boyle here in just a second and what's been going on with natural gas. But yes, I definitely should be doing more day. And I'm focusing on it. Again, I have a lot of things going on at this moment. So sometimes I can't sit there and focus on those things as I want to intently during the day. But I'm making time for it. Has the market hit a bottom now? I personally don't think so. Again, Robert, my forecast for the beginning of the year, and I'm no more expert than anybody else. I think that you're going to just have, because of this data, I've got good data coming out on one hand, I've got bad stuff coming out on the other hand. Obviously, Intel reporting earnings tonight, rocking the boat. Let me show you the Intel earnings real quick. The good news is Intel is not a heavy hitter with regards to index weighting, right? It's not a major component in the NASDAQ 100 or the S&P or the Dow. It's in all three, so it should have an impact, but it's not a heavy percentage piece. So we were up 1.31% as Intel rallied with the markets, but right now it's down 8.7%, trading at 27.47, which is right there. Actually, not a bad spot. So I may look at this in the morning. I want to read through what the press conference said and what their forecasts were. I may actually look at trading some options in the morning on this one because the premium should be pretty high as people are freaking out. But as far as markets bottoming, let me bring up that S&P 500. Is this the bottom? I don't think so. You look at this chart right now, and the good news for anybody who's bullish is we are breaking some short-term highs, right? That gray line sloping down really represented a pretty strong downtrend going back since January of this year, and irrefutable trend line. The fact is, we broke it a couple days ago, and now we're starting to see maybe new highs put in. The key here is you want to see if, when it does pull back, which it will at some point, you want to make sure that it doesn't break this most recent low, right? So that's this blue line here. Let me get this line off of there. I'll leave this uptrend line just because. We'll leave the triangle just for reference. But this lower blue line, which I will make it the only blue line by deleting this other blue line, right? This lower blue line represents the low from January 19th and 20th. If we get below that, then we'll start to challenge these lows again. But if this is going to keep on trending, it has to hold that low. So right now it looks great. My expectation is we'll probably pull back, maybe tap 4,000, and then slowly drift up. But again, it all depends on economic data. Remember, next week is a huge week with the FOMC. You have Apple reporting earnings. You have Amazon reporting earnings. I think Google is reporting as well. So I personally don't think that the bottom is in. But then again, Robert, let's be honest here. Does my opinion matter? No, it doesn't. I don't think the bottom is in. I think at some point this year we will break those lows of 3,600. But, you know, I've been trading to the long side. So even though I'm somewhat bearish on the market for the year, I'm still just riding what that market gives me. So it really doesn't matter what my opinion of is the bottom end. I don't believe so, but, you know, who knows? It could come back. As Rob says, wait for a correction into a demand zone. Right. At this point, I'm looking for buying opportunities to join this uptrend, right? And unfortunately, I jumped out of some of my stuff a little bit early. I could have rode those options and the underliers that I was in a little bit farther, but you know, I do believe the mantra that you can't go broke taking a profit. And as long as I get a rate of return that meets my objectives, hey, I'm happy to take that profit. You know, I look at some of the other ones that I've been in and you're like, oh God, why didn't I keep, like GLD was a great example, right? I got exercise on GLD. I sold the 165 calls. I got to 165, took my GLD away from me, and now it's trading at 179. I was like, damn it, if I just kept it. But as you guys all know, in this profession, I think more so than any other, you can't say I should have, I could have, or I would have. You just can't. It's irrelevant. Move on. I'm waiting for another opportunity in gold. That ship has sailed. Do you have a tool to predict a recession like we have the Fed funds rate? Well, a Fed funds rate doesn't predict a recession, right? Let me go to the first part of your question. It says, will the Fed be right about the soft landing given all the economic numbers? Will they get it right this time? I don't believe so. I don't believe that there will be a soft landing. I think that there's been too much manipulation of the money supply and stimulus to warrant a soft landing. Could it happen? Absolutely. Again, I think that the challenge that we have, Ganesh, as traders, is I don't really need to look out 6 months, a year, 2 years, 5 years, 10 years, right? Obviously, we can all pontificate and say, yes, I think this is going to happen for all these reasons. The reality, and the reason why I like doing this show is whether you are bullish on the economy or bearish is one thing. Whether you're a Democrat or Republican is one thing. Whether you are gay, straight, transgender, or alien is a whole nother thing. It doesn't impact the trades that you make. The key here is I need to make sure that what the market is giving me is what I take advantage of. I personally think that there's just too much negative stuff out there that my gut tells me the market's going to be going down, but they're not. So if I hold on to my opinion saying, hey, I think these markets are going to go down, I'd be getting my clock cleaned right now, right? I'd be losing tons of money because this market's been ripping. Instead, I'm trading exactly what I'm talking about, these patterns. I'm trading the pullbacks. I'm trading the trend zones, or trend lines. I'm trading zones. And I have to stay with that information there regardless of what my opinion on anything is. And if you start to develop an opinion about something that's overly biased, or you say, oh, this has to happen, then you're probably going to end up in some pain there. Sideways, Joe says, sideways trend until it breaks out. Could be a good place to short indexes if the stars align and the signals present themselves right. And if they do, Joe, then what do you do? If the stars align and all the signals say, hey, go short, what do? You put some trade on, or a trade on, maybe not all in, and you start there with a defined risk amount. And if it starts to move down and go in your favor, maybe you start snowballing in, add more and more and more. And if it really crashes, then you got a monster winner on your hand. Right now, for me, it's just base hits. Base hits, I got a couple doubles. I got triple last week. Some good stuff. All right, let's see. Do you ever use logarithmic scale for your perspectives? Any benefit to it? If you look at most of the indexes, they're technically above the downtrend line. So when you go long, logarithmic, they are below. Yeah, I don't use logarithmic. I know some people love it, which is awesome. It's just if you're going to look long term, like going back decades, I think it's fine to use logarithmic scale. But, I generally don't look back decades, right? Most of the time, if I'm looking back, it's going to be a year or two. So if I go here, let me show you the chart. This is standard right now. If I go logarithmic, it shifts a little bit, but not enough to really make a difference in my world. Now, if I'm going back, this far, yeah, this absolutely makes a big difference. And Tom always gives me a hard time because I look at Bitcoin sometimes. And he's like, put it in log. Yeah, you're right. This changes quite a bit. Especially, I'll show you the big example really is Bitcoin. Bitcoin's hilarious when you look at it non-logarithmic. So let's put Bitcoin on a weekly. The weekly. And you can see going all the way back to what TradingView has data on, going back into 2011, that's logarithmic. This is not. Right? So it kind of makes sense to use logarithmic for the longer term stuff, but I really don't care on the short term. When I'm doing a daily, going back a year or two, logarithmic doesn't really make a big difference to me. But, to each their own. If you like logarithmic better, go with it. Just because Tom likes logarithmic on the show, I'm turning it off just for Tom. That's for you, Tom. Let's see. If the S&P daily 50-period moving average closes above the 200-period moving average, that would trigger buying. They're only 33 points apart. Yeah, Liz, that's called the golden cross, right? So you have going log scale all time is an eye opener. Yeah, but Tom, but it doesn't really. If you're trading something over the next couple of weeks or a couple months, it's not going to change much. So if you, I'm not going to add those on here, but if you take the 50 and the 20. And you look for the crosses there. That is historic. Okay, fine. Just, you know what? Damn you, Liz. Or Lisa. Who put that one in? Liz. It's all your fault. Now I got to take the time, add in the moving averages. There is one. And we'll put on a 50-period moving average there. Great. Let's see if it allows me to do it. I don't think it will because I have too many things. and I don't have the subscription, so let's go moving average. Yeah, it's not going to let me do it. Let me close out one of these. Hold on. I have ATR at the bottom and stochastics. I can get rid of stochastics. All right, now let's see if it'll let me do it. And we go to moving. So a golden cross is where the 50-period moving average crosses above the 200, and the death cross is where the 50 crosses below the 200. All right, so there's your 50. Let's add the 200. We'll change the color on this bad boy. And this is a pretty common thing that people are looking at. They love to look at this golden cross, death cross in the markets, and there you go. So what's noteworthy here, and this is on Bitcoin anyway, we'll move it to something else. I'm just kidding, Liz. It's fine. I like the interaction. It makes it fun. What's noteworthy here is that the 200-period moving average for Bitcoin has been pretty much sideways, right? It's almost totally horizontal. But the 50 is curling back up towards it. And you don't need to be a rocket scientist to figure it out. Just look at the price chart. I mean, if you look here back 200 days, you can see it's been pretty flat. And now all of a sudden it's starting to hook up. So that one's a kind of obvious one. Let's go to the S&P. So this is a little bit more concerning. And what's interesting is when we look at the pattern that we drew on the chart, right? We drew those trend lines connecting the peaks that go back to January and the lows that go back into October, at least the real bodies from October. Those are those two gray lines. I think they're gray. I'm colorblind, so I believe they're gray. But notice when we add those moving averages on it, the red represents your 200-period moving average. The blue is your 50. They're pretty much representing the same thing. It tells you that in the shorter term, it's been on an uptrend, but long term, it's still on a downtrend. And our trend lines tell you the same picture. Kind of funny. So what are we looking for? They're really close. And if we do get this blue line above the red line, which would be the 50 going above the 200-period moving average, it's a rather positive sign for the market. That would be called a golden cross. Now, until the 200-period moving average starts to curl up, I'm not going to be overtly bearish. I'll certainly be bullish on, I'm not going to be overtly bullish. I'll be bullish, but not like really bullish, right? I really want to wait until that 200-period moving average starts to, it's still trending down. If we keep this activity going like it has been over the past 2 months, the 200-period moving average will start to flatten and then curl up. Now, if you want to be super aggressive, you buy when the 50 crosses the 200. If you want to be really aggressive, you wait for that 200-period, or really conservative, you wait for the 200-period moving average to curl up. Notice last time that happened, this is, by the way, a very lagging indicator. I mean, very lagging indicator. Here is the last time that the 50 crossed the 200. That was on March 11th of 2022. I'll put a vertical line for you guys so you can see that one. Vertical line right there. Right? And what I love about this type of stuff is people always, especially when I teach classes, they go, oh, well, if you would have gone short when those cross, they just simply go over here and go, oh, you would have gotten out when it was trading at 4,466. I was like, no. When those cross, price was down here at like 4,100. That's another 300 points lower. Really, if you look at this price chart here, and of course we can all be Monday morning quarterbacks and look after the fact, using moving averages is very lagging. We'll look at this. Right there, you had multiple signs. You had price. This is, by the way, for the podcasters, I'm going back into January of 2022. In January, you had price cross below the 20-period moving average. You had the 50-period moving average rolling over. You already broke one demand zone, two demand zones. So there are already four major signs that you should have gotten out of your long positions back in January of 2022. And then it really, had a lot of chop, but been trending down ever since. Right? So I think using moving averages, death cross or golden cross, whatever you want to call them, to me is a little bit lagging. All right, good questions. Intel was at $32 in 2002, post Y2K, burst after 20 years down. If so, when to exit a monopoly? Well, who knows? It's not about exiting a monopoly. It's not about exiting monopoly or joining a monopoly. It's saying, what does price tell you to do? Not what Jim Cramer says, not what the media says, not what, an article or a press release, which is generally done by the company itself, but what is the chart telling you? So Intel came out with earnings today, right? INTC. This chart has been telling you, well, actually this is old data. Let me go back here. This chart has been telling you, stay short. If you were to use the moving averages, 200-period average is still saying stay short, trending down, right? No brainer there. The way I look at it is a little different. I would look at it and say the Merlin way would be, hey, we are consolidating. We've had this period where it's been stuck in a pretty wide range between, call it 24.75 and 31 bucks. Right now, you're creeping towards the top of this, and the 50-period moving average is moving up. So even though Intel came out with horrible earnings, it's starting to look better, which is part of the reason why I am potentially thinking about selling some puts tomorrow. I want to wait and see what the premium is like. Intel, I don't think is going to go away. Certainly, they lost their market share to AMD. AMD and Nvidia, and a lot of the chip space has been just kicking their butt. But it's Intel. They'll reinvest themselves. I saw a mention in here that they're not doing much CapEx, not a lot of capital expenditure. Yeah, I don't know. I'm not looking at that stuff, but Intel knows they have to, right? They have to be developing new products, new services. Otherwise, they will go under. So I'm okay potentially owning some. Again, I'll reevaluate this tomorrow morning and see if it's worth it for me to sell some puts on it and see what the premium is like. But right now, it's down 9%. There's going to be people freaking out tomorrow, paying a ton of money for put options just to get that protection for their portfolio. So, as far as it being a monopoly, Ganesh, I don't really focus on that. I don't really care, honestly. Honestly, if this chart made nuclear bombs or toilet paper, I would trade it exactly the same, right? Nuclear bombs, toilet paper, they could make widgets, they could make batteries. It doesn't make a difference what this company does. I'm looking at the price chart. And at this point, saying that I want to, go long on Intel, you're going to counter trend. It looks pretty bad. I'll have to wait and see, Alan. I would probably see if I could get the 24s. And if I can get, for 1 month, I would probably want to get 2 or 3% rate of return. I'll look to sell the February 21st. I'd look to try those 24s and see what I get 24. Because that's been the low during this whole consolidation period going all the way back into October. So that makes me feel a little more comfortable about it. When was the last time that Intel was this low? Going back into 2000, I have to go a weekly chart to find out when it was this low. Last time it was this low was in 2015, right? It's been a long, long time for Intel to be at this price. So not that it's, can't go bankrupt. They certainly could, but it's Intel. I think they'll probably stick around. And then Intel is almost a 5% dividend. Nice, good to know. I wouldn't be personally interested in that, but hey, if you're going to add that as a little icing on the cake, all right, I'm good with that. So there you go, Ganesh. And I didn't mean to sound disrespectful by saying I don't care about monopolies, but don't overthink things. Don't overthink it. Trading at its best should be boring and simple. When you look at all these different factors and someone says they're a monopoly or they're the leader in this or they do this or I think you overthink it. You can go down that road of fundamentals and analyzing all the little nuances of each company, which might give you a competitive edge to some extent. But I think personally, price is just the easiest way to look at it. Very simple. I can make an opinion and set up a trade based off this chart in about 10 seconds. Just boom, look, okay, great. Rob says, W pattern, demand zone, low on the curve. Can we go long? You certainly can go long. If you look at the big picture, yeah, all those things are true, Rob. However, and this is a big asterisk, you are going counter trend, right? No argument. You're going against the grain here on Intel. Intel has been crap for years, or at least 2 years, right? It really hasn't done anything since 2017, moved up a little bit, but now it's just cratering. And of course, you could point the finger a lot of different reasons why. However, during that big tech rally, they weren't rewarded with that one. It seems like they kind of suffered during that tech rally. So the fact that we're consolidating does not mean we're done selling off. The 50 says we are, but the 200, which is more powerful, says we're still going down. You could argue, yes, the double bottom. If you wanted to make a more solid trade on this and just kind of be more conservative, you wait for it to break above 31 bucks. Okay, if it gets above 31, boom, jump on it and see if this trend actually reverses and put your stop below one of the more recent lows, probably this one down here around 28 bucks, right? So you're risking $2 per share, or sorry, $3 per share. However, I'm looking right now, it's trading at 27.19. If I can get this thing at 27.19 tomorrow morning and sell those 24s or 24 puts, which is down below these lows, then I feel much more confident, right? I'm going outside of those lower demand zones. Am I going to get as much premium? Probably not. But do I care? Not really. Again, the key for me anyway is consistency over time. You have to have some sort of system structure in that you can be consistent. I don't want to be swinging for the fences and strike out all the time, because ultimately you'll just blow your account, especially when your psychological damage comes into play and you're like, man, I've been losing and losing and losing. You'll just disappear. You'll shrivel up and no longer be able to trade. Next thing you know, you're like sending out resumes trying to work or get somewhere again. Nope. Let's see. What did I got? Questions. Talking about Monday morning quarterbacks. As a California native, I have to root for 49ers. Just can't get behind the Philadelphia Beagles. Yes, that's right. It's going to be a good one. You know, here's the reason I got to cheer for the Niners. Obviously, I'm a diehard Niners fan. But everybody that I've been listening to, all these analysts and experts, are saying that Brock Purdy, compared to Jalen Hurts, is nothing. That he's far inferior of a player. And you know what? If that doesn't give this guy enough firepower or motivation to go out there and say, no, listen, you say my arms are too small. The arguments are he's too short. He's got really small arms, like they're really short. But he's got one of the highest passer accuracy ratings out there. So I want to see the Niners win just because I have too many friends who are Philadelphia Beagles fans. Bye, Beagles, bye. That's what it's going to be. All right. Liz says, on the Golden Cross, isn't the point that institutional buying will increase, which could be a further rally? Correct. I agree. It's a lagging indicator. I already took my, yep. Yeah. So years ago when I was working for a financial planning firm, and this is, I think it's changed, but in the prospectus, there are a lot of companies that will specify what they can hold in their portfolio or not. And I remember looking at a couple of mutual funds, which would say, if a stock is below its 200 period moving average, we can't buy that. We have to liquidate. So now that something goes above its 200 period moving average, they might be able to acquire or accumulate those positions, which in turn does what? Creates buying pressure. So yes. And I think on a bigger scheme, Liz, what you're going to get when that happens, and we'll watch the media, watch the news when we get the S&P 500 to do, let's go back to the S&P. When that crosses, you will see headlines that say, Golden Cross, markets look bullish, or markets poised for rally. The first Golden Cross that we've seen. I mean, the last time we saw one was back here in 2020. That's the last time we had a Golden Cross. That's when the 50 goes above. So the media will take it and run with it. And what that does, it brings in more people into the fray. They'll jump on because all of a sudden they're feeling bullish and bullish and bullish and bullish. So there you go. SOXL, huh? Oh, the semiconductor triples. Look, if you're bullish on the sector and you're making short-term trades, then I think you're fine with that. I think that it's kind of dangerous to be trading these triple leverage ones. Of course, I'm talking about going double long natural gas, which is insane with Boyle. But if you look at the picture here of it, what do you have? You've got higher lows and the same highs. You actually kind of have a breakout. You're sitting right on that 200 period moving average. So it does look good. And I think for a swing trade, like literally it can't be that long, like a couple days, maybe a couple weeks max, it could really be a big play. But Intel is crushing that right now, right? Intel obviously is a big component of the semiconductor index, the SOX. And because Intel's down 9%, I'm going to be maybe even more tomorrow morning, this index is going to take a big hit, which could disrupt that pattern. Right now it's down here at 1450, but it was at 1525 just a little while ago. So I'm okay with it. It looks bullish. It's starting to become bullish, although you are seeing it come right into that 200 period moving average, which acts as a psychological supply zone. All right, Boyle. So let's look at UNG real quick. So I was talking to John Rowland today, and he's like, I said, hey, man, where's the floor on crude oil, or natural gas, excuse me. Here is natural gas futures, right? Oh, that's NASDAQ. Let's go end. There's my futures on this bad boy. There's natural gas. So natural gas has been atrocious. Like, it doesn't look much. It's hard to find something right now that looks worse than natural gas. It's just absolutely horrible. You do have a hammer formation that formed today, right? You get this nice hammer formation that formed today. Now, we could look back and see if it hits demand zone, whatever, but it's just that the hammer formation by itself after just such a colossal decline. And then here's the real kicker. Let me add on volume. Need a minute. Oh, I was looking at UNG. So here, let me go from that to UNG, which is natural gas ETF. Look at the volume today on natural gas ETF. That is absolutely climactic volume, monstrous. So today, I sold puts on UNG. So I actually sold the $9 puts for April. which is, I actually made a mistake and I went to change it and I couldn't. So I was moving too quickly. I have some friends in town, so I was trying to get something else. So I made a mistake. I would never have sold the puts that are that far out. I would never do that unless you screwed up. So I actually had an order to close out my trade for a small gain today, but it didn't get filled. Either way, I'll probably be closing that trade sometime soon because I don't want to have that much time for the option. That said, the $9 put was earning me $1.15. So really, if I got executed, I'd be executing at $7 and change. So I'm actually kind of okay with it. It's a really great rate of return, but it's also for a few months. Not just the numbers come out. Well, natural gas numbers come out every week. And really what it is, in talking to John Rowland, he was saying it's the largest speculative short position. So speculators are shorting this thing at the highest levels in 18 months. So everybody's shorting it right now, which tells you what? Well, if everybody's shorting it, the window opens for a short squeeze. So I'm buying natural gas. I will probably buy some UNG. I might buy some call options on UNG. And I did boil for a one-night trade. Literally, it's going to be out tomorrow at close. And I'll tell you more on that in just a second. The reason being is we're due for a pop. You don't get this kind of aggressive sell-off, particularly in a commodity like natural gas, without getting a little bit of a pop to the upside. So even if this thing jumps to $10 or $11 in the next couple of days, that'd be a pretty significant gain, particularly if I'm with the options contract. So I bought some, I sold the UNG puts, but I also bought, let's see. So I sold the Boyle puts today. So this is a double long natural gas. And I see, I think so, Liz. I think a squeeze is coming. What did John R. say about it? He didn't. I want to bring him on to talk more about that. But I saw someone who said, there he is. Naum says he bought some Boyle today. It's dangerous. It's very dangerous because Boyle could continue to decline. But I think you're going to see a pop here. I think you have climactic volume. This, to me, is a very positive indicator for a reversal. When you have volume that's 3-4 times as much as normal, typically that is a sign that it's capitulation. They all just dump their shares at once and they're freaking out, done. So that kind of tells me we're near a bottom. Also the price, if you look at natural gas itself, here's NG. We're at 294 right now. Could we go lower? Absolutely. Natural gas futures have a hammer formation. It just feels like we're due for a pop. So I'm looking to play this for the short term. I sold the $8 Boyles. Let me bring this up real quick. So I sold the $8 Boyles today and I collected 25 cents worth of premium. It expires tomorrow. So really it's a 4% rate of return for one day. Now, of course, if I get executed tomorrow, let's say Boyle closes down below 8, well, my dollar cost average my cost basis will be $7.75. I will probably right away sell the weekly calls at $8, right? Just to continue to lower my cost basis. But I don't think we'll get filled tomorrow. All right, if the Fed is pulling out money in the market because of inflation, why a dollar is getting lower and the market is going up? Well, it's just falling out of favor, right? It's not necessarily just that the Fed is retiring money. That's one element. That's one factor that contributes to the decline in the U.S. dollar. But remember, there's macroeconomic pieces as well. Part of it is just current trend, people getting out of the dollar, maybe moving into other markets, right? The dollar was the hot spot to buy because the trend was so strong. But now, if I look at something like the euro's the hot spot, right, Rob? Look at, if you had your option to hold euros or dollars, which one would you rather be in right now? So people are selling your dollars, buying euros. They're actually buying British pounds, right? They're getting out of the dollar. So that's causing the dollar to fall faster. And these other currencies, the Australian dollar is ripping right now. This move up in the Aussie dollar is pretty impressive, right? It was way down here. Now you're seeing, the move in 75 days, it's increased 15%. That's a pretty monstrous move. And the euro is the same picture. That's the main reason I would say, Rob, is people are saying, all right, dollar's trend is broken. You can see it on the Dixie. Let me bring it up one last time here. There's the Dixie. Okay, dollar's trend broke. You could have said it broke when it crossed the 50 or broke when it crossed the 200, or just draw your own trend lines, or maybe even broke recent demand zones. Whatever. Doesn't matter which one you're using. They're all saying sell. Everyone. So if traders using moving averages, tells them to get out. If they're using supply and demand, it told them to get out, and the trend is broken. So there you go. It's just about rotation of money. And it's funny, when one asset class sells off, generally money flows into another asset class, and the key is to figure out which asset class that is. All right, now that was fun. Good stuff in there. I had a couple questions. So I have questions that got sent into the YouTube channel. I'm going to answer those tomorrow. So Philip, Les, you also asked some great questions. I'm going to get to those tomorrow because I got to run and do some other things. Here's your economic calendar for tomorrow. It's not over yet. We have, drum roll please, another major piece tomorrow morning. That's 1 hour before the equity markets open. That is the core PCE price index. You also have personal income. You have personal spending, pending home sales. So tomorrow, it just keeps on coming. There's big data tomorrow. That PCE one is the one to watch, right? If PCE, they're expecting a rise in PCE, given the inflation numbers that we saw over the past couple weeks in PPI and CPI, I don't think you're going to get 0.3%. I think it's going to stay at 0.2, and that could cause further market rally. But again, that's all speculation. Don't take it as trading advice. Do your own research when that market opens up. All right. And lastly, economic calendar or earnings calendar. You got Chevron reporting earnings tomorrow. Healthcare, HCA Healthcare, American Express, and Colgate-Palmolive are some of your bigger names. And that, my friends, is your show for today. Chase says, I'm not convinced the dollar move isn't just doing a 2001 move and gearing up for another rally. It very well could, right? Yep, I think I had, there we go. Liz, I beat you to it. Yep, I got AXP and Chevron on there. So big names, more fun. And I will have a glass of whiskey tomorrow. It's just been a great... Trading has been really good. I hope you guys are doing okay with your trading. There's been some very nice moves recently in the equity markets and crypto and futures. I mean, just some good opportunities out there. And now you're starting to see a little bit more of a trend versus the chop that we have been seeing. So hopefully you guys are doing well. All right, guys, if you enjoyed today's show, do me a favor, hit the like button. Send me comments and questions for tomorrow's show. You can do that by putting them down below any YouTube video. Just go to TraderMerlin, pick one of the videos, and say, hey, here's my question. I will put it in the slides, get to those questions on tomorrow's show. Trading is a thrill a minute, Chase, unless you're just talking about me, but trading is a thrill a minute, man. It's just every week is different. It's just we're looking at different things. I think trading keeps you young because your brain always has to be working and working and working and taking information. So enjoy, everybody. Hope you had a great day. If you like the show, you can hit that thumbs up, like button, or email me, TraderMerlin@gmail.com with any thoughts, concerns, what have you. I will see you all tomorrow. Take care.